Ladies and gentlemen, good day and welcome to the Q4 FY22 earnings conference call of Mass Financial Services Limited, hosted by Elara Securities India Private Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shweta Dattardar from Elara Securities. Thank you, and over to you, ma'am.
Thank you, Stephen. Good evening, everyone. On behalf of Elara Capital, we welcome you all to the earnings conference call of Mass Financial Services Limited to discuss the Q4 FY22 performance. From the management, we have with us today Mr. Kamlesh Gandhi, Chairman and Managing Director, Mrs. Darshana Pandya, Director and CEO, Mr. Ankit Jain, Chief Financial Officer, and Senior Management Team. Without taking much of the time, I now hand over the call to Mr. Kamlesh Gandhi for his opening comments, post which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Shweta, and good evening, everyone. I'm very happy to connect to all of you once again. While we have the presentation and the press note already published, but just for better understanding, I'll take you through the basic strategic intent of the company with the headline numbers. So as we all know that we passed through the most unprecedented time of our lives through COVID pandemic. And as I always shared with you earlier also, that the main focus of the company remained to strengthen the balance sheet as we have been doing it since last more than 25 years. And while this was an unprecedented time, but the challenge, we have navigated such type of challenges in the past too. So that gave us a good insight on how to navigate through this. And the net result is that we are once again on the growth trajectory as we were before the pandemic started, and hopefully things being normal, we are once again on our normal growth trajectory of 20-25%. While this quarter also we are very near to that with close to 17% growth in AUM, corresponded by the 17% growth in profitability, with an all-time high disbursement of close to 1,950 crores, indicative of the fact that businesses across all the segments we work have not only survived but are now started growing gradually. On the fundamentals, to take you to the fundamentals, we maintain a very strong capital adequacy of 26%, out of which around 23% is Tier 1. So once again, that gives us the room to grow at the rate which we desire and which we aspire. And as we all know that we have a very strong self-propelling capital model, but even with the growth in AUM, the capital adequacy always stands very strong, and the intention of the company is to maintain anywhere about 20% going forward. In terms of distribution, we increased our distribution, as I had shared with you in our earlier call, that we are actively working to increase our branches and distribution. And in those lines, our distribution is now at around close to 5,000 centers, which is reflected in rise of our retail assets, whereby our direct distribution contributed 52% of the business as compared to 42% last March. And our distribution through NBS is at 48%, which was 58% last March. Having said that, we value both the distribution equally, but as time and again I have been reiterating that since the pace at which our distribution will increase will be much faster than at which the pace of our tie-up with NBS will increase, and hence this result and hence this shift, which will be going this way, I anticipate in this year also. On the products, we continue to focus on our flagship products, that is micro, small and medium enterprise loans, which contributes more than 80% of the loans we give. And two-wheeler and commercial vehicle also contributes around 10 to 12% of the total AUM. With the normalization of activities, we presume that there will be increased contribution from those products also. And within MEL also, from next quarter, we are trying for a better credit and risk assessment and exploring the possibility on small ticket size personal loans. The MEL loans which were given being used for the personal purposes, which will try to identify as small ticket size personal loans going forward. So that can be an addition to the product slowly and gradually. In terms of technology, I think working on technology has become an integral part for all of us. So updating the technology and advancing on the technology from time to time remains our main plan, and that will help on to increase the efficiencies. We are trying to adopt technology, and we are trying to have the digital cycles, digitization in all our product cycles which we work in. That's why the result which should result into customer delight and better credit dispensation within our lines of an intention of extending credit where it is due. So we just to give you a hint on that, we have tied up with close to 20. We have now close to 20 API integration, which helps us in decision making, and we are also increasing our reach on technology on origination and onboarding the clients as well as on the credit decisioning. On the housing, now I take it to the housing finance business. On housing, we registered 11 to 12% growth. But once again, as I always I would like to reiterate that with a smaller size, we'll be in a position to get into a growth trajectory of anywhere between 25 to 30%. And we are seeing that possibilities right from Q4. And we are confident that that business will also start contributing meaningfully. Very important to share is about the quality of the assets. The quality of the assets remains very strong at 1.7% net stage 3 of the EM and in our parent company, and at around 0.5% of our net stage 3 EM in our housing finance company. And still, in our parent, we continue to hold a special buffer of 0.75% of our own book assets. And in our housing finance business, we continue to hold more than 1% as a special buffer on our own book assets. This is in line with what we think that as a lender, we would like to seize on the opportunity whenever we get to create buffers, which I think with normalization will also normalize going forward. The way forward from here, with around 6,500 crores of consolidated AUM, we firmly believe that we are on track, as with sounding repetitive, that we are on track of a normal trajectory of 20-25% growth with a strong enablers of a very strong capital adequacy, very strong liability management, while Ankit and Dashraman will take you through the numbers in detail. But if I just give you the heads up on the liability management, we already are therefore we already tied up for almost 2 to 3 quarters this year also. So this being a very strong enabler, and along with a very strong team of more than 2,000, we are now a team of 2,000, increased from 1,450, which was last March, and counting. So with all these strong enablers, with the vast market size which we serve, we are confident that we are well on track for the growth which we have demonstrated over all these years. I think I'll be missing on a point if I don't talk about the current interest rate hikes. I think we all knew that it was around the corner, but this was a little sudden and little more than what we all had anticipated. But bearing last 3 to 4 years, rate hike has been a very regular feature in our journey. So we have clue on how to manage such rate hikes. Ultimately, as intermediaries, our role is to pass on the money from the saver to the consumer. So when the rate hikes, as NBFC, we don't use money for ourselves. It has been lent to the borrowers. So ultimately, the borrowers will bear the rate hike, whatever it happens. At the same time, we'll try to be as efficient as possible by calibrating and recalibrating our borrowing configuration, so that we are in a position to get the minimum rate hikes and hence pass on the minimum rate hikes. In between, during the duration, whatever whatever the transition will happen, that will happen slowly for us because majority or almost all our lending is not EBR based lending, but it is MCLR based lending. So it takes time for transmission. So we'll get sufficient time to adjust our books accordingly. And secondly, our average book tenure being around 18 months gives us a further room to calibrate the rates with more than 75% of our assets under an arrangement, whereby if the need be, we are legally competent to raise the rate if required. So this is how we will be navigating this rate hikes anticipation without causing much stress on NIM and hence the ROA. So this is from my side. I will hand over to Dashaman to take you through numbers for better information, and then to Ankit to give views on the liability management. Over to you, Dashaman.
Thank you, sir. Good evening, everybody. I welcome you all to this earnings call for financial year 22. So we started this year with the AUM of 5,372 crores. And we all know that the Q1 there was a dip in AUM in Q1, and then we then the 3 quarters were normalized, and we closed at 6,246 crores. And if we look at the configuration, product price configuration, our MSME portfolio is around 88% of the AUM, which is 5,524 crores. And Wheels portfolio is 12%, that is 723 crores. If we look at the growth numbers, we grew our MEL portfolio by around 9.39%. SME loan portfolio, there is an increase of 21.49%. Two-wheeler loan portfolio grew by 15.52%, and commercial vehicle loan grew by 70.14%. Here, the percentage looks high because the base is very small. If we look at the total income on Q-on-Q basis, it has grown by 29.66%. Last year it was 139 crores, and this year we ended at 180 crores. Profit before tax, there is an increase of 13.55% on Q-on-Q basis. So last year, profit was 50 crores as compared to 56 crores this year. Profit after tax, there is an increase of 16.55%. So for this year it is 42 crores as compared to 36 crores last year. If we look at the Y&Y numbers, income due by 10.70%, 657 crores this year as compared to 593 crores last year. Profit before tax grew by around 10%, that is 211 crores this year as compared to 193 crores last year. And the profit after tax grew by 10%, that is 157 crores as compared to 143 crores last year. If we look at the quality of the portfolio, our stage 3, gross stage 3 stands at 2.28% as compared to 2.35% in December 21. And net stage 3 stands at 1.70% as compared to 1.76% in December 21. And here I would like to mention that this is on real-time basis according to RBI guidelines. We still hold COVID provision of around 38 crores as on 31st March, which is 0.74% of our total on-book assets. So this was about the parent company. Now coming to the numbers of housing finance company. Our portfolio, we closed at 316 crores as compared to 285 crores last year, that is 11% growth in AUM. Total income is 8 crore 86 lakhs as compared to 8 crore 57 lakhs last year, that is 3.30%. PBT stands at 1.5 crore on Q-on-Q basis as compared to 28 lakhs last year, and the PAT is 1 crore 22 lakhs as compared to 20 lakhs last year on quarterly basis. So last year there was an impact of 76 lakhs of special COVID provisioning in the profitability. So hence these numbers. On yearly basis, our income grew by 1.58%, that is 35 crore 83 lakhs as compared to 35 crore 27 lakhs last year. And PBT, there is an increase in PBT by 52.64%, that is 5 crore 78 lakhs as compared to 3 crore 78 lakhs last year. And PAT stands at 4 crore 56 lakhs as compared to 2 crore 89 lakhs last year, that is 58.16% increase in PBT. Coming to the portfolio quality, gross stage 3 asset as on March 22 is 0.53 and net stage 3 stands at 0.38% as compared to 0.69 and 0.49% in December 21. And here also we hold COVID provision of 3 crores, which is 1.19% of our total on this asset. So this was about the key numbers for both the companies. Now I'll request Ankit to take you through a liability management.
Thank you, ma'am. So good afternoon all. To further elaborate on the liability management, currently we have a liquidity buffer of around 800 crore and unutilized cash flow facility of around 400 crore. In addition to this, the company has sanction on hand to the tune of more than 1600 crore in the form of term loan, direct assignment and co-lending, which will be sufficient or good for next 2-3 quarters. In the last quarter, company did around 350 crore direct assignment transactions with various banks. The company further has more than 1000 crore sanction on hand, which will be utilized during the current year. The company aims to maintain around 20-25% of AUM as off-book through direct assignment and co-lending. In the last quarter, company did around 50 crore co-lending transactions. The company plans to do further tie-up in co-lending with banks, which will be in proportion for both the entities. Company has available cash flow facility of 1825 crore, out of which we utilization level is of 65-70%, and this portion is kept as a liquidity buffer. We raised rupees 535 crore term loan during the quarter with an average tenor of 3 to 5 years. This helps us to further strengthen the asset liability maturity pattern. We have sanction of 600 crore on hand, which will be utilized during the current quarter. We'd like to highlight that in acknowledgement and recognition of our business model with partnering of NBFCs and MFI, SEBI has come up with the SEBI has sanctioned of rupees 300 crore, which is under their special support of double intermediation scheme, whereby they will be extending credit to us for on lending to our NBFCs and MFI partner. So this is a line they have sanctioned us for rupees 300 crore. On the structural liquidity, if you see, company has assessed its structural liquidity for the period ended 31st March, and based on the assessment, there is no negative impact on liquidity, and the cash flow remains positive in all the buckets. We are adequately capitalized, whereby the total CAR is around 26.35%, with a Tier 1 capital of 26.08%, and debt equity of 3.48 times. The cost of borrowing for the quarter remains stable at 8.67%. Also, would like to highlight the LCR, that is the liquidity coverage ratio, stands at 193%, as against the regulatory requirement of 50%. So this is on the capital and liability management, and I hand over the mic to Kamlesh for closing remarks.
So that's all from our side on sharing the information and the strategic intent of the company. We'll be happy to take the questions regarding our business.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankit from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations for a very good, very recent set of numbers and with the highest ever disbursement during the quarter. So my question was on the fees and commission income. If we look at it, despite such a sharp increase in disbursement and our focus towards, lending through our own branches, we saw a dip in our fees and commission income on YOY and QOQ basis on the income side, and subsequently even on expenses side, there was a sharp increase, while on the expenses side there was a sharp increase on fees and commission expenses on a YOY basis. So if you can explain that, it would be helpful.
So as I shared last time also, that we have changed the model with our partners, whereby first it was netted off, and now what we do is that we collect the complete installments for better operational control, and then the same is shared with them as fees and commission. So first of all, it was shared upfront, but now we have a practice with many of the partners where we think it is necessary, whereby we book it in our book first, and then it has been given to them as fees for origination or for the activities they undertake for us.
Sure. And the significant increase in fees and commission expenses?
So that was for that. That fees and commission is been given to our partners, yes, with whom we have the partnership arrangement for sourcing, origination, and what all arrangement what we have for them for creating the assets. As I shared, that first the things are netted off, but now we are collecting the installments. We are having the complete control on the cash flow, and once we get everything, we part with them. So that is just a change in the business model.
Sure, sir. And second question was on the fintech lending tie-up that we are doing. So, how do you see this segment, growing for us over the next 2-3 years? And, we do hear about the risk associated with this. If you can address that a bit.
Sorry, if I heard you correct, you're talking about fintech, right?
Yeah, fintech partnership and the tie-up that we have done with our partners. So how do you see this segment expanding for us over the next 2-3 years? And, what are the key risks associated with this segment going forward?
See, as far as our fintech partners are concerned, we are slowly and gradually increasing our partners. So we are working with various partners currently. And in such a manner which aligns with our dictates of extending this view and within our lines, within our area of operation and within our lines of products. What we do is that we talk out there also that we have the filters of credit screen, where we use their platform is that since they have a platform, the origination is done through them, but complete filters, the credit filters and the assessment is done jointly by us. So I think in Q4 we did a disbursement of more than 200 crores through various fintechs. And we see that increasing slowly and gradually as we find the opportunity working with them without compromising with the quality of the assets. The biggest thing while working with fintech is to see the quality of the assets. Because right now the arrangement is such that we are immune from any of the losses. But having said that, we are conscious of the fact that the portfolio as a whole should behave in such a manner that it creates a win-win situation both for fintech and for us. So that we are very optimistic on this tab, but the only caveat is that we'll have to go with the ones who understand the importance of quality, irrespective of what capital they have, and we are working closely with them to drive all the fintechs we work with on those lines.
Sure, sir. And I wish you all the best. And that is it from my side. Thank you.
Thank you. The next question is from the line of Harshvardhan Agrawal from IDFC Asset Management. Please go ahead.
Hi, sir. Good evening. Thanks for the opportunity. So just wanted to understand if I were to look at the quarterly PPOP numbers for our company over the last 5-6 quarters, that has been stagnant at around 60 crores. That's at PPOP level. So if you can just throw some light as to why is that, despite say 20% growth in our AUM, our PPOP numbers are not growing?
So if you, there are various reasons for that. Now PPOP is a function of the operating environment also, because if you see since last 3-4 quarters, the major thing is that we have been carrying an excess liquidity on the book. We have been very conscious on the credit we extend to various borrowers. So thereby the risk-taking capabilities were limited, and hence that had the impact on the yields that we got. So these are the various factors which affect the pre-operating profit. But going forward, once the thing stabilizes, because no 2 years are comparable, because last 4 quarters it was just the matter of getting the credit right and getting the liquidity right. So carrying excess liquidity on the balance sheet and reducing the yield and trading off the yield with better quality of the assets are the key reasons for PPOP being stagnant. And secondly, normalization of activities, increasing the operational expenditure also, because this year we expanded from close to 95 branches to 125 branches, from 3,500 centers to 5,000 centers. So these are the various reasons due to which we think that we are hovering around that number on pre-operating profits.
So sir, so basically probably going forward, our PPOP growth should more or less mimic the loan book growth, right? Is that an understanding correct?
It cannot be an apple-to-apple comparison, but more or less it will be on those lines.
Okay, sure. And sir, another thing that I wanted to understand was the excess liquidity that we're carrying, because if I'm not wrong, we mentioned that around 800 crores of liquidity buffer that we are carrying. So any thoughts or any plans to reduce this liquidity buffer?
Yeah, so we will be we will be happy with around 400 to 500 crores of the buffer. So within a quarter, I think we should be there, because once we create a buffer, we cannot reduce it overnight. So we are gradually reducing it, and we'll see to that it hovers around, say, 400 crores. As such, for many years, we had managed that only the unused liquidity in the CC is the liquidity. But post that ILFS prices lesson learned, that even CC's cash rate limits temporarily, bank have the right to freeze, and they might do it practically also. So we have started keeping this liquidity buffer, which will not be as high as 800 crores, but will be close to around, say, 400 or 500 crores, which will translate into, we should be in sync with our disbursement and repayment plans. And approximately it comes at around anywhere between 4 to 5% of our AUM.
All right, sir. And so one last question on the fintech piece. What I heard, if I heard you correctly, you said the disbursements were at around 200 crores this quarter, right?
Yeah.
But if I remember, even in 3Q we had the same level of disbursement, and at that time we mentioned that probably we will increase our disbursement run rate to somewhere around 20-25% of our total disbursements. So hypothetically, let's just say we had around 2,000 crores of disbursement this quarter, so maybe around, say, 500 crores. Obviously, it won't happen in a quarter or so. But just wanted to understand your thoughts as to are we seeing some issues with these types, because we have not ramped up on a sequential basis this disbursement number.
So when we give a guidance of 20 to 25% is on a yearly basis. So it all depends upon the opportunity we get with various fintechs to work and the way we tie up, because the fintech tie-up is a very operationally time-consuming thing. So we need to integrate our systems, and we need to have common links and all those stuff. So we would like to operate once we are through on the operational part of it. So maybe the operational part with few of the companies took more time. So that would not have reflected the real intention. But we see the opportunity at 20 to 25%. But at the same time, we would not like to make ourselves accountable on a quarter-to-quarter basis. On a yearly basis, I still see the opportunity of growing at around 20 to 25%. Once again, with the condition, if we are satisfied with the overall quality of the portfolio, and we take our own time in synchronizing our operations with them.
Sure, sir. Thanks, sir. And sir, one last question on the fintech thing itself. You also mentioned that at the moment we are immune to any losses in this fintech lending. So do we have some FLDG tie-ups with the lender, with the fintechs?
Yeah. So we work with the fintechs who have a front-end NBFC model. So we are yet to scale up a module only where there are only fintechs and originating for us, while we are exploring and understanding how they really work. But there has not been a sizable business done with a fintech platform only. So we work with the fintech companies which have an NBFC front-end model. So the complete technology is they use the technology, and the first loss guarantee is given by the NBFC.
Sir, and if you can share what's the FLDG given?
It depends upon the product, but we insist anywhere between 10 to 20%.
Oh, sure. Thanks a lot, sir. That's all from my side. Thanks again.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Madhuchanda Dey from MC Pro. Please go ahead.
Yeah, hi sir. I have a couple of questions. The first is I'm just harping on the interest margin question again. It seems like from a calculation that there was a slight dip in margin sequentially also in the fourth quarter. So any particular reason? And I also wanted to get your views on RBI has already hiked the repo rate by 40 basis points yesterday, and there are expectations that rate might go up by another anywhere between 75 to 100 basis points. So given this backdrop, where do you see your NIM trajectory for the year? I have a couple of more questions which I'll further ask. Hello.
We would endeavor to keep our NIMs anywhere between 6.5 to 7%. Given normalization of our liquidity buffers, it should hover around between 6.5 to 7%. Now, coming on the aspect of interest rate rise, so as I shared in the opening remarks, that majority or almost all of our borrowing is MCLR based. So we are not going to get the rise overnight. And there are reset timings as far as interest are concerned, right? So that will give us the room to calibrate our lending also accordingly. And secondly, on the asset side, around 35% of the assets are such whereby if there is an inevitable interest rise in between, we can pass it on to the customers, which will be very negligible for a small borrowers in terms of what they have to pay extra. But for a company, we'll be in a position to preserve our NIMs between 6.5 to 7%. That is what we foresee right now. Maybe there can be pressure in because of the transition that we do, or the transmission rather that we do from our lending to from our lenders to borrowers in increasing rates. So maybe there can be a small pressure for a temporary period of time. But having said that, in past also we have navigated through such interest rates, and we have done the same thing, whereby we get some time. There is a lag effect on the increase. By that time we try to set the things right with our borrowers also. The new lending will also factor in the interest rate hike. And secondly, our product asset cycle is also 18 months. So a combination of all such things on a yearly basis, I presume that we should be in a position to preserve our needs. That is what currently it looks like.
Sir, you said 75% you have pricing power, some kind of a pricing clause. Is that right?
75?
You said with 75% of the borrowers you have a clause to reprice. Is that correct?
Right. That's correct.
Yeah. Okay, sir. My second question is, you also alluded to getting into unsecured lending. So that's a completely new turf, right? You have not done unsecured so far. I mean, why getting into this at this stage? What is kind of the logic? And basically, I just wanted to understand the logic behind this kind of a diversification, and that comes with usually a huge risk of asset quality, especially for the kind of borrowers you usually target. So, any comment on that?
So my point was that the annual loans which we give, and we all know that many of them use that for their personal purpose also. So what we thought and what we have decided is that for better credit assessment and understanding, we are going to bifurcate the ones who are using for personal purpose. So maybe certain areas what we are lending right now might be used for personal purpose, personal use, might not be only for the business use. So that will be one bifurcation. And secondly, as you know that the way we venture into any new segment, we are not going to go very gung-ho on that. There will be a very gradual increase in the asset size of those type of loans. But having said that, if I share with you that we have done this product in the past, whereby we used to give personal loans to small businessmen and salary earners. But since our focus shifted only to MSME, we had shifted our focus mainly on creating MSME portfolio. So slowly and gradually we'll taste the water if it thinks that it can add on to our asset size without compromising with the quality of the assets, because that is also a class which will need money from time to time because of the timing of the income or because of the shortfall in the income, but ultimately are good borrowers to work with. So we have the first-hand experience having done this product in the past, and we will see to that how slowly and gradually, without affecting our overall quality of the assets, we can build up this product.
Sir, I just a housekeeping question. That is, Madam mentioned that this NPA has been computed as per the 12th November guidelines of RBI. Am I correct?
Right.
Yeah.
Right.
I have a slightly longer term question, pretty macro question honestly. That is about this whole NBFC model. With the merger of one of the largest NBFC now with a bank, there is increasing question about the robustness of the NBFC model, because banks with their cost of fund advantage and now they are getting into all the turfs which were previously like the forte of NBFC. So, I mean, beyond a certain size, any NBFC would face those kind of headwinds. So, what is your plan, strategy, and how do you react to this kind of, scenario?
So, the medium-term vision of 10 years, where we see ourselves growing at around 20% on an average. What looks like around 6,500 crores can be close to around 45,000-50,000 crores. And at that size, I strongly believe that this model has a lot of value to offer to the borrowers. In terms of the merger, definitely getting merged with the bank has its own advantages, but I personally believe there are certain disadvantages also. So the class of the borrowers who we serve, the huge credit gap along with the growth in the Indian economy, I think we'll need banks and NBFCs both, and both will find their specialty, the way it is being right now done. So banks entering the NBFC space, or NBFCs also now allowed to issue credit cards and all. I think India is a story of coexistence and not only of existence of few. So given the huge market size and given the strategic intent to add value to the borrowers and through operational excellence, I think for coming 10 years, if I have a vision for 10 years, I think at around 45,000-50,000 crores, this model looks quite viable and value-adding. And we can definitely take a call post that. But we are firmly aligned to a strategic intent of being in this format for at least a decade or so.
And that's a very valuable answer, sir. Just one last question.
Sorry to interrupt, ma'am.
Just one last question, sir.
Sorry, ma'am, but we have
Okay,
participants.
I'll come back to the queue. Thank you.
Thank you. The next question is from the line of Parag Jariwala from White Oak India. Please go ahead.
Yeah, thank you. Can you give me the breakup of our on lending to NBFC and our own generated book split? Maybe in percentage would be fine for the last quarter.
I think that is 48% is through NBFCs and 52% is directly generated through.
Okay. And how was this, let's say, a previous quarter? Third quarter?
That was 58%.
That is March 21.
21, yeah.
Last week December.
No. I'm asking for the maybe you can give both the figures, maybe fourth quarter last year and maybe previous quarter or third quarter FY22.
The fourth quarter was, I think, 58% through NBFC, which is 21 here.
Yeah.
21 March is 58%, which is now 48%.
And in December it was 52%.
It was 52%.
Okay. I think the ratio is changing very fast, right? I mean, so where do you see the numbers, let's say in 23 end and 24 end?
I think, to give a range bound number, I think our NBFC distribution will hover around 40 to 45% as it looks right now. And our direct distribution will be close to 55 to 60%.
Okay, over the next 1 year?
Over next 1 year.
Okay, that's great. And mainly the on-book would be driven by MSME, SME portfolio, which we are, kind of aggressively invested in previous few years, right?
Yeah. So we are aggressively increasing our distribution. As such, this was the plan last year, kept on hold because of COVID. So from 3,500 centers, we grew to 5,000 centers, and I think by the year end, we will be covering close to 7,000 centers to increase our reach to at all the areas where we find potentiality to extend loans for the borrowers we serve.
Yeah. Okay. Thank you. I mean, that's what I wanted to ask.
Thank you.
Thank you. The next question is from the line of Bhavesh Kanani from ASK Investment Managers. Please go ahead.
Thank you for taking my question. I hope I'm audible.
Yes.
Yes, sir. So, sir, when I'm looking at the AUM mix, one of the largest segment for us, micro enterprise loans, has been one of the last ones to see growth. Effectively, we ended FY20 at 3,600 odd, and the current micro enterprise loan is still lower than that. Whereas other segments like SME, which is sizable, has grown at a healthy rate. Two other segments, two-wheeler and CV, while small, have still grown at healthy pace. So what exactly are the reasons which are still keeping us cautious on something that we consider to be our core business, that is micro enterprise loans? And incrementally, for achieving the kind of growth we are looking at, 25% kind of growth, I would assume a micro enterprise loan segment will play important role in achieving that kind of growth. So if you can help us understand the slow growth currently and incrementally how you are looking at this particular segment.
This is in line with our strategy to grow our SME books. How we identify is MSME segment. So that is micro, small and medium enterprise segment. And we firmly believe that as we grow our balance sheet size, our ticket sizes should also increase. So anything given less than 3 lakhs is identified as micro enterprise loans, or anything above 3 lakhs is identified under small and medium enterprise loans. So our focus to increase our ticket size is leading a healthy growth in the SME space and relatively lower growth in the micro enterprise space. So overall, when we say on a 10,000 crores balance sheet size, if we say that this is going to contribute around 7,000 crores, we will be happy to see it being contributed by each. That is 3,500 crores by SME and 3,500 from micro enterprise loan. Having said that, this is a very ballpark figure, can vary depending upon the situation we come across and the opportunity we come across. But the basic idea is to increase the ticket size as we grow, and the opportunity we get to grow along with our own borrowers also. The borrower to whom we have funded 2 lakhs of rupees is now qualified for 3 lakhs or 5 lakhs, or going for a machinery loan or a very longer term loan will be our target customer. So this is in line with our intention of growing the ticket size.
So, is it right to assume that incremental growth will be more driven by SME loans than micro enterprise loans?
Yeah.
Okay. And the implication of that, what broadly would be the difference in yield that we charge on micro enterprise versus, let's say, SME?
See, ultimately, the target will be to maintain ROAs at around 2.75 to 3%, because followed by the yield are the operational cost and the credit cost. So looking at the dynamic of the operational and the credit cost, the yield will be decided. But at the end of the day, whether it is micro enterprise loans or MSME loans, we'll try to maintain the ROAs anywhere between 2.75 to 3%.
Okay. Thank you. That answers my question.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir. Sir, first question on the liquidity buffer. So right now, did I hear it correctly that it is around 800 crores and you target to reduce it to 400 odd crores in the next few quarters?
Yeah. Yes.
Okay. So that would add around maybe around 30 odd crores in our PPOP, right?
It will be done over a period of time. So we have to do the calculation on that. I don't have any back of the envelope calculation on the same, but definitely it will have a positive impact on the pre-operating profit, because we will be saving an amount on the negative carry.
Understood, sir. And sir, now we have rapidly expanded the branches. At least last year, if I heard it right, we increased it by 25 odd %. And obviously there will be some growth in the existing branches as well. So given that, shouldn't we be targeting a much higher growth than 20 to 25% for FY23?
Every branch, any branch which is started will not yield result right from day one. It takes time. So in line with the curing time which each branch requires, and the strategy is also not to do a substantial business as soon as we start the business in a particular place. So the strategy is to develop the branch for the long-term objective and not just for a year. So the combination of the strategy and the practical scenario, we think that even after opening the branches, we will be ending up at around 20 to 25% growth, and we are capable from the capital and the liability management side that if we get an opportunity to grow more, so be it. But the guidance what I like to give to all of you is anywhere between 20 to 25%.
You have also said, sir, that we are trying to do more on the technology side. Now, given that at least the image of the company is that we were more on the older way of doing things, and now there is a lot of stuff which is happening on the fintech side. But at the same time, we also have been believers of believing in touch sort of a model. So from an organizational perspective, from outside, is there a dedicated team which is looking at the technology and trying to integrate with the entire organization? So if you can give some more color on what exactly are the steps that you are taking to sort of change the pace at which we've been doing things on the technology side previously versus now. I think that should be helpful, sir.
When we talk about tying up with fintechs, it's an association between two organizations where one is an expert in technology, other is expert in finance. So when we talk about our approach to financing, I not term it old or new, but the approach to financing remains the same, that extending credit where it is due. So we see to that by using technology that is enhanced and not compromised. So our tie-up with fintech definitely helps us to gain edge on the technology front, and we get that ready-made platform from those guys. Having said that, we are strengthening our internal team also. We have a team of more than 30 people in analyst and the software team in order to tie up with various fintech companies so as to be in sync with the market practices and also to improve our digital journey of the products we sell directly. So, and along with that, we'll be taking the help of the experts from outside. So we have a capable team within our organization who is managing this.
Understood, sir. Thank you and all the best for the coming quarters.
Thank you. The next question is from the line of Rahul Maheshwari from Ambit Asset Management. Please go ahead.
Good evening. Am I audible?
So if you can speak closer to the device, please. Your voice is not clearly audible.
1 second. Yeah, is it better now?
Sure.
Yeah, couple of questions. Thank you. First, when we look at between the AUM and borrowing, no doubt this year has been it has been much better managed. But when we look at the borrowing as compared to the AUM growth, can you give some bit of color that the borrowing run rate on a YoY basis is 24-25% as a growth as compared to AUM growth of 16%? Just because of the higher liquidity perspective, we have taken a higher borrowing this year, or can you provide some color that why the difference in growth between them both is high?
So this is because of the on-book and off-book fee structure. So the off-book was around 25 to 30%, which was our direct assignment book, which is not a part of borrowing. But now, as we are going to our 10,000 crore AUM, what we have made an internal policy that assignments will not be more than 20-25%, and therefore that ratio has changed, which has resulted into a borrowing on-book borrowing increasing as compared to AUM.
Okay. So and plus the borrowing is entirely MCLR based. Nothing of is on external benchmark rate or something for you.
It's MCLR based. Borrowing is MCLR.
So either it is fixed or MCLR borrowing, based lending.
Okay. A second question, as you mentioned in your presentation that your current leverage continues to be in the range of 3.5 to 3.8, and you said that going forward you would be remain at an optimum level. What is that optimum level? It will remain at the same run rate where it is, or where do you aspire to take it?
We would like to hover around 4, so to say, as of now.
So for next 2-3 years, we can take it as a 4 as a good leverage for Mars at a 2025. Hello. Hello, am I audible?
It will be around, it's currently around 3.8. Going forward, it can be around 4.25. This is what I can visualize currently.
Okay. And second thing, I also wanted that many NBFC players are struggling on the two-wheelers as a segment. No doubt our two-wheeler segment.
Maheshwari, can you take the phone off speaker, please?
Is it better now?
Yes, sir. Please proceed.
Yeah. Because I have to guess so many things. I can just understand 50% of it. So I might not be in a position to respond effectively. Yeah, please.
Sir, I just wanted, hope I am clearly now. I just wanted to understand that though the two-wheeler segment is just contributing 5 to 6% of the overall portfolio, but we have seen across the NBFCs are struggling in this segment from an asset quality perspective. Can you give some color that how mass portfolio on two-wheeler is completely different from there, though the ticket size is nominal, but still. Hope I was audible, sir, this time.
We have been one of the oldest two-wheeler financing company, and if you see the two-wheeler portfolio has not grown to that size, and the major reason being conscious on the quality. There are so many practices that are being adopted just to get the number, which we have not adopted, and as a result of which we are in a position to maintain the two-wheeler quality portfolio which we are looking right now.
Okay. And sir, just last question, just a feedback, sir. When entire industry in the housing loan is able to grow, where mass is not able to clock that run rate of growth, are we just in the investment phase, and from here onwards we can expect the same kind of growth? It would be very helpful to understand why the growth on the additional portfolio which we are growing at 15-20% is not reflected on housing book.
As you know, post ILFS and post DHFL, where so many things were unveiled, and we were also not in a position to understand that how the market dynamics because of the various fundamentally flawed model operating in the market. That was one, the demand opening up. As you know that even pre-COVID also there was a slump in demand in affordable housing. And third was that we were not ready to look the other way on the certain practices which have been adopted by maybe bigger housing finance companies or even the smaller housing finance companies. There are various such practices which, while we do not approve of that. So we took our own time because we thought that housing finance is a very long-term business, is a wafer-thin margin business. We developed our distribution channels, we developed our team who can really understand us, the way we work, and that took us time. And now since the things are started moving positively, the flawed fundamentals are being corrected to a large extent by the experience what the housing finance companies had from various debacles they created. So all in all, a conducive situation for companies like us who would not like to grow at any cost is there now for us to grow at anywhere between 25%, maybe on a smaller base up to 30%. But once again, the priority will remain on the quality of the assets, profitability and growth.
Absolutely. Thank you so much.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. On behalf of Elara Securities Private Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.